A 401k is a retirement savings plan offered by many employers. It allows you to save and invest a portion of your paycheck before taxes are taken out. This can reduce your taxable income now and grow tax-deferred until you withdraw the money in retirement. Two key benefits of a 401k are tax-deferred growth and, in many cases, an employer match. Tax-deferred growth means you don't pay taxes on the money you contribute or on the earnings until you withdraw it in retirement. An employer match is essentially free money your employer contributes to your 401k based on how much you contribute, usually up to a certain percentage. Over time, thanks to compounding interest and investment growth, this investment can grow into a substantial nest egg for your retirement. Let's dive into some details. The first step in maximizing your 401k is determining how much to contribute. The IRS sets annual contribution limits, which can change year to year. For 2024, the limit is $23,000 with an additional catch-up contribution of $7,500 for those aged 50 and older. To decide how much to contribute, start by aiming to contribute at least enough to get the full employer match. For example, if your employer matches 50% of your contributions up to 6% of your salary, try to contribute at least 6%. Otherwise, you're leaving free money on the table. Let's break down a simple example. Suppose you earn $50,000 per year and your employer offers a 50% match on contributions up to 6% of your salary. If you contribute 6% of your salary, that's $3,000 annually. Your employer will add another $1,500. So, by contributing $3,000, you end up with $4,500 in your 401k for that year. Next, increase contributions over time. If you can't afford to contribute the maximum amount right away, don't worry. Start with what you can afford and gradually increase your contributions over time. Many plans offer an automatic escalation feature, which increases your contribution rate by a certain percentage each year. This is a great way to boost your savings with minimal effort. Automatic escalation is particularly effective because it aligns with potential salary increases, meaning your take-home pay doesn't decrease significantly. For example, start with a 3% contribution rate and increase it by 1% annually until you reach the maximum or a comfortable level for your budget. Let's review some investment choices. Once you've set your contribution amount, the next step is deciding how to invest your 401k funds. Most plans offer a range of investment options, including mutual funds, index funds, and sometimes company stock. When choosing investments, consider your risk tolerance and time horizon. Younger investors with a longer time until retirement can generally afford to take more risks and might benefit from a higher allocation to stocks. As you get closer to retirement, it's wise to shift towards more conservative investments like bonds. Diversification is key. Spreading your investments across different asset classes can help reduce risk. Many plans offer target date funds, which automatically adjust the asset allocation based on your expected retirement date. For example, a target date fund for someone planning to retire in 2050 might start with a higher percentage of stocks and gradually shift to bonds as the retirement date approaches. This helps manage risk as you get closer to needing the money. Next is to monitor and rebalance. Regularly monitoring your 401k is crucial. At least once a year, review your account to ensure your investments are still aligned with your goals. Market fluctuations can cause your asset allocation to drift, so you may need to rebalance your portfolio to get back on track. Rebalancing involves buying and selling assets to maintain your desired allocation. Some plans offer automatic rebalancing, which can make this process easier. Let's say you have a target allocation of 70% stocks and 30% bonds. After a year, due to market performance, your portfolio might be 75% stocks and 25% bonds. Rebalancing would involve selling some of your stocks and buying more bonds to restore the original allocation. There are a few common mistakes to avoid with your 401k. First, not contributing enough to get the full employer match. This is essentially leaving free money on the table. Second, cashing out when changing jobs. This can incur taxes and penalties, and you lose out on future growth. Instead, consider rolling your 401k into your new employer's plan or an IRA. Third, taking loans from your 401k. While it might be tempting, taking a loan from your 401k can derail your retirement savings and may come with penalties if you can't repay it on time. And fourth is ignoring fees. Investment fees can eat into your returns over time. Choose low-cost investment options whenever possible. Now let's review how to utilize Roth 401k options. Many employers now offer a Roth 401k option. Unlike traditional 401k contributions, Roth contributions are made with after-tax dollars. This means you won't get a tax break now, but qualified withdrawals in retirement are tax-free. A Roth 401k can be beneficial if you expect to be in a higher tax bracket in retirement. It also provides tax diversification, giving you flexibility in managing your tax burden in retirement. Let's now look at catch-up contributions. If you're 50 or older, take advantage of catch-up contributions. For 2024, this means you can contribute an additional $7,500 on top of the standard limit. This can be a powerful way to boost your retirement savings, especially if you started saving later in life. Let's look at required minimum distributions, RMDs. Once you reach age 73, you're required to start taking distributions from your 401k. These required minimum distributions, RMDs, are calculated based on your account balance and life expectancy. Failing to take RMDs can result in hefty penalties, so it's important to stay on top of these requirements. Create a withdrawal strategy. As you approach retirement, developing a withdrawal strategy is crucial. This involves determining how much to withdraw each year to ensure your savings last throughout your retirement. Consider working with a financial advisor to create a strategy that balances your income needs with tax efficiency. A common rule of thumb is the 4% rule, which suggests withdrawing 4% of your retirement savings annually. For example, if you have $1 million saved, you would withdraw $40,000 in the first year of retirement. Adjustments can be made based on your spending needs, inflation, and investment performance. Maximize your contributions. To maximize your 401k contributions, take full advantage of any employer benefits. Some employers offer profit-sharing contributions or additional bonuses that can be directed into your 401k. Also, consider adjusting your budget to increase your contributions, especially if you receive raises or bonuses. Understand plan fees. 401k plans come with various fees, including administrative fees, investment fees, and individual service fees. These fees can significantly impact your savings over time. It's important to understand the fees associated with your plan and choose low-cost investment options when possible. Take advantage of employer resources. Many employers offer resources to help you manage your 401k, such as financial planning tools, educational workshops, and access to financial advisors. Take advantage of these resources to make informed decisions about your retirement savings. Plan for healthcare costs in retirement. Healthcare costs are a significant consideration in retirement planning. Estimates suggest that a couple retiring at age 65 might need around $300,000 for healthcare expenses throughout retirement. Incorporating these costs into your retirement planning is crucial. One way to prepare is by contributing to a health savings account, HSA, if you're eligible. HSAs provide tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Mastering your 401k contributions effectively involves understanding the basics, setting appropriate contribution levels, choosing the right investments, and regularly monitoring your account. By avoiding common mistakes and taking full advantage of employer benefits, you can build a solid foundation for a financially secure retirement. Diversify retirement income. A well-rounded retirement strategy includes multiple sources of income. In addition to your 401k, consider other retirement accounts like IRAs, Social Security benefits, pensions, and taxable investment accounts. Diversifying your income streams can provide financial stability and flexibility. For example, having both a 401k and a Roth IRA allows for tax diversification, helping you manage your tax liability more effectively in retirement. Staying informed and adapting your strategy. The financial landscape is constantly evolving with changes in tax laws, market conditions, and retirement benefits. Staying informed and being willing to adapt your strategy as needed is essential. Subscribe to financial news, attend workshops, and regularly review your retirement plan. Flexibility and informed decision-making will help you navigate changes and optimize your retirement savings. If you found this video helpful, please subscribe to our channel for more financial insights. Thank you for watching and see you on the next one.